Hi guys. Today we'll take a look at an introduction to aggregate demand and aggregate supply. This is by far not the only time you should be getting content from it, and for the rest of macroeconomics, we will be working with these two concepts and how they achieve equilibrium, and then what governments do to try to align goals to this big concept. So we will take a look at what aggregate demand is and the aggregate demand curve, and you guys will graph that. What short-run aggregate supply is and the equilibrium point then that's achieved in short-run aggregate supply, long-run aggregate supply and equilibrium in the classical model, and then the Keynesian model with aggregate supply and equilibrium, and then what happens when we shift aggregate supply over the long term. And as I said, we'll get into a lot of these in much more depth and as we get throughout our particular unit. When we did the introduction to overall macroeconomics, I used the word aggregate to talk about demand and supply. And aggregate is just when you have a total combination of separate units that come together. And in this case, we spent a good bit of this year looking at demand and supply from microeconomic perspectives. And now with macroeconomics, we're going to combine all of the demand of one domestic country and all of the supply of one domestic country into aggregate demand and aggregate supply. When you do that, you lose the ability to look specifically at one industry or specifically at one good or service, but the overall picture can give us some very interesting ideas about how the country-wide economy is running. Let's start first with aggregate demand. Aggregate demand is the total quantity of output that all buyers in a country can buy at different price levels, all things considered. So aggregate demand as a curve will look a lot like the demand curve, because as the price level of all goods in the economy drop, the overall output, or real GDP, and if you want to call this, if you want to label this, you call this on this axis as Y, or output, the variable for Y, or you say just real GDP, and on this axis you can call it price level. The overall output and price level, as the price level drops, the overall output for the economy should increase. And as the price level increases, the overall output will decrease. Increasing price levels we'll talk about called inflation. Decreasing price levels, all else being equal, as the price of things go down, as prices deflate or come back to an equilibrium level, you'll see an increase in real GDP. Again, way more on that later. This is the demand for all consumers in an economy, for all goods and services. Keep that in mind. We lose the ability to differentiate or specify what's going on. Aggregate demand is the same thing as real GDP. Remember, real GDP is GDP of a country that's adjusted for inflation year after year. So you can see that GDP, again, is consumer spending plus investment spending plus government spending plus net exports minus imports. So, my guys, please put that in your notes as graph number 32. And we'll talk about what the different points on the curve and how to shift the entire curve would look here shortly. Certainly stuff you want that will go along with your graph. Now, I want you to write these down, but this is not where you're going to spend the bulk of your time with aggregate demand. There are three components that will shift. Sorry about that. There are three components that will shift aggregate demand along the curve: wealth, interest rate, and international trade. Shifts along the curve are not nearly as common as shifts of the entire curve. So, as the price, going through these one at a time, for wealth effect, as the price level of a good or of all goods in society increase, a consumer's wealth decreases, right? And a fall in the quantity of the output demanded follows that. And that would sort of make sense. Interest rates are a little trickier because as to right now, you're not real clear on what interest rates are. But again, we'll come back to this, but it makes better sense to put it with your background information on aggregate demand that you can then revisit. As the price level increases, the cost of loans in society increases. As the cost of loans increases, there's a fall in the quantity of output demanded. Again, a shift along the curve. International trade will make a little bit more sense as we get into year 2 economics, but again, for the sense of clarity and holistic judgment here, if the price level of goods increase and the prices of other countries stay the same, exports in the domestic country become more expensive. If exports in a domestic country become more expensive, then you have a lower quantity of output from the domestic country. You see a decrease in, or a movement along the curve for that particular country. It makes sense to write these down, but what you're going to see more of are shifts of the entire curve. Shifts of the entire curve are things that increase or decrease GDP, real GDP, as a whole. These things can be quantified as changes in consumer spending, changes in investment spending, changes in government spending, and changes in net exports and imports, or foreign spending. Okay. For my students, I really want you to know and to be able to say whether the curve shifts for one of those four big areas. But as you can see, there's a multitude of things that would fit underneath each category. You want to be able to think about why it is consumer spending that shifts the curve and tie it to something specific. But as we practice, I expect that you'll be able to at least say that the shifts occur because of those four big categories. I have a practice activity that you'll do after this lecture where we'll see some of these things together. Things that affect consumer spending that would shift the entire curve will be consumer confidence, how consumers feel about the economy. Changes in interest rates can shift the entire curve, monetary policy-wise. Changes in personal wealth, changes in personal income taxes. Decreasing income taxes increases consumer spending, and the opposite would be true. Increasing taxes decreases consumer spending. Changes in the level of indebtedness. And the more in debt a household is, the less they can spend. The less in debt they are, the more propensity to spend and go into debt or to spend money in general on new goods and services. You'll see consumer spending a lot. A lot of economists believe it's the consumer spending that really drives the economy. Investment spending particularly comes from a bunch of different categories, but here we have business confidence, changes in the interest rate, and again, when we get to monetary policy later in this unit, we'll come back and look more specifically at that. Improvement in overall technology. Technology getting better helps businesses better do what they do, can boost aggregate demand in an investment perspective. You'll see an overlap with that for short-run aggregate supply. Changing business taxes gives them the ability to spend more for their business. The level of indebtedness again, and legal or institutional changes, things that are done in society that make it easier for businesses to spend money or less, or more difficult. Government spending, anytime the government spends more money, we see an increase in aggregate demand, and less money, a decrease in aggregate demand. That's tied to something called fiscal policy. And again, fiscal policy comes up in a lot of detail later, so I ought to highlight, here's fiscal policy that comes up a lot later. So is monetary policy, you'll see that come up a lot later. Just important that we will come back and touch on those things in a lot of detail. Changes in foreign spending can shift the entire curve one way or the other as well. National income, we've called GNI. So changes in GNI abroad will affect spending for goods and services in the domestic market. Changes in exchange rates, that'll be a topic we get into year 2, but you'll start seeing some of now after we learn the year 2 topics and we come back and review for the IB exam to see a lot more there. But changes in the level of trade protection also is a year 2 topic, but it's something that you just need to know now, that if a country exports more goods, if they export more goods here, you're going to have an increasing GDP. If a country has to import more goods, you're going to see a decrease in GDP, which means increasing GDP shifts the entire curve to the right. Decreasing GDP shifts the entire aggregate demand curve to the left. So an increase in GDP means a shift to the right for the aggregate demand curve. A decreasing GDP means a decreasing aggregate demand or shift to the left. Now, aggregate demand is one of the biggest drivers of the economy. Moving forward into the next couple of slides, you'll see that aggregate demand, and when we get to your practice example, aggregate demand is really the thing that pushes a lot of what we look at in the domestic economy. Now, short-run aggregate supply are changes to the business marketplace in a domestic country. This is a time when the price of resources are roughly the same. So you don't see a lot of changes in the prices of goods or prices of factors of production. Um, the prices of the resources change the same, but the overall curve shifts left or right. As the price level would go up, a producer in an economy would be more willing to produce their goods and services. So just like supply in microeconomics had this same shape or same increase, in macroeconomics, when you consider all the goods together, you see that as the price level of things go up, so does the overall real GDP for output at that price level. Do it in a different color here. Real short run aggregate supply will change when wages change. That's the first category. I didn't break them down as I did on the previous slide because these are much more specific. So changes in wages will shift the entire curve left or right. Changes in non-labor prices. So changes in things like the cost of natural resources or the cost of renting a factory. Those things will shift curves left and right. The changes in business taxes will shift the curve, aggregate supply curve left or right. And since taxes and subsidies are really the opposite of each other, I should just consider those things together. Changes in taxes or subsidies. And number 4, I have supply shocks again, but in microeconomics, we learned about supply shocks as an issue that would affect the supply of a particular good or service. So a frost in Florida that kills off the fruit trees before they're able to produce fruit, which commonly happens in spring, or at least is a threat to happen in the spring in Florida. That's a supply shock for one industry. For supply shocks for short-run aggregate supply, we're looking at a good that is so pervasive in the industry that a supply shock there has ripple effects throughout the economy. So a supply shock killing off oranges in Florida doesn't affect the whole economy. Not nearly as much as a supply shock like the OPEC nations in the 1970s with really limiting the production of oil and limiting supplies to the United States. That really affected the overall economy of the United States. In a smaller country like Indonesia, a supply shock can be a natural disaster. The tsunami in the early 2000s in Indonesia really had a massive effect on their economy. So supply shocks, I don't want you to think of as one thing that affects one industry. It has to be a pervasive, countrywide issue. And when you have a country as big as the United States or Canada or China or Russia, those supply shocks are less likely. But when you have small countries like Indonesia, well, Indonesia is not small per se, but when you have smaller countries like Indonesia or smaller island nations, you see the supply shocks more likely. Or honestly, when you have an economy that's so focused on the production of one good and service, like Nigeria with the production of oil, a supply shock could also be as likely there. So again, make this graph number 33 in your notebook. We'll come back and talk a little bit more about the sloping short-run aggregate supply curve. If you put these two things together, you're going to get an equilibrium level. For my guys, for the time being, I would like you to graph what would be graph C here. And then we'll talk about ways that you should notate these other graphs. You're going to have short-run aggregate supply and aggregate demand now on the same graph. Please notice that the axes are labeled as price level and output, or PL and Y. Let's assume the economy is at full employment. That means not that they're using all of their resources, but they're using all their resources at the most allocatively efficient level. That's going to give us a price level equilibrium and an output equilibrium. When the equilibrium output is the same as potential output, if you remember back to your business cycle graph, potential output is the upward sloping trend line of the ups and downs of the economy over multiple years. When potential output and the equilibrium level are the same, we can say that the economy is at a full level of output. Now, don't graph the other graphs that are listed here as A and B, but I want you to take note of what's going on. If there is a deflationary gap, if YE is less than YP, as you can see here, If YE, the equilibrium level, falls below the potential level, that means we're in a recession. The economy is producing lower than its potential overall level. When the and so you want to make a note of this in your notebook. Sorry for the pause there. My computer timed out. I had to readjust. When you have a situation where the equilibrium level is greater than potential, it's a boom period in the economy. We're producing above the potential level. This is called an inflationary gap. You also might see it called an expansionary period. It's a period of growth. Sorry about that. That's a period of growth or expansion again. All right. So I am only concerned that you graph C for right now, but you want to make a note in your notebook if YE is less than YP, then this occurs. If the equilibrium level is greater than YP, then this occurs. Okay? And again, we're going to practice this a lot, and you'll become pretty comfortable with identifying and talking about what that means. So, a couple of notes to make, and I had said a good bit of this on the last slide, so I'm not going to read through all this with you, but you want to pause and take a look and make sure that this stuff makes sense. Now, there is a small difference between short-run and long-run aggregate supply. Long-run aggregate supply, let's take a note of next, is when all the factors of production are able to change in relation to price level instead of just one. There are two big ways of taking a look at this, both the classical and the Keynesian model. For right now, I only want to talk about the classical model. We will dig into John Maynard Keynes and the Keynesian model in our next big activity of this unit. Sorry about that. I have a poorly edited slide here. I'll fix that. Okay. The classical model of long-run aggregate supply looks a lot like what you just put into your notebooks. I wish I could get this to edit now. Sorry for that. There we go. Now, the difference from what we had done before is we add a vertical line at the potential output level called long-run aggregate supply. Since the wages and all other resources can change to match any price level in the economy, long-run aggregate supply is going to be perfectly inelastic. What's that mean? It basically means that supply in the long run is irrespective of price level. Supply will continue to be to match the potential level regardless of the price, or match that equilibrium level regardless of the price. So if all the prices in the economy are going up or down the same, producers don't need to increase long-run aggregate supply to make a profit. They're able to produce at long-run aggregate supply at a potential level. If this doesn't make conceptual sense, you certainly want to go back and read our textbook. And for my guys, it's Cognitive, but it might be Tregakis or Blinken-Dorton or whoever you subscribe to. But you want to read about like why this happens. But the economy can shift this long-run aggregate supply, this potential level, in a growth pattern, or unfortunately also the economy could contract. So we can see shifts of the long-run aggregate supply both to the right and to the left. We're going to skip him for now because, like I said, we'll come back to him. You want to make a note in your notebook that John Maynard Keynes has a different view on macroeconomics. You don't need what's on this slide as notes, but it's important to know who he is, and we'll get into him a lot. And honestly, for the time being, you can skip what this is too. It doesn't hurt. You could pause it and put it in your notebook, but we'll look at a different video on this for our next video or our next lesson. And we can see, again, the same sort of language is used here. Recessionary gaps, inflationary gaps, and equilibrium when the same conditions occur as we saw with the short-run aggregate supply. All right, so again, we'll come back to Keynes more tomorrow. Okay. When the long run aggregate supply shifts, either in the classical model or in this case the whole short run or the whole aggregate supply shifts for Keynes, uh, it the whole curve will shift when you either see increases in quality or increases in quantity or quality of any of these three factors of production. So, focusing first on quantity, things that could increase the amount of land or natural resources in the economy. I've given you some examples of. Things that could increase the labor in a country. I've given you some examples of. Or things that could increase capital or investments in business in the economy. You can see examples of. I want to go back to labor for a second. I want to point out that immigration is an increase in quantity in an economy, and we'll see what that does in a bit, but it's an interesting scenario. Increasing birth rate also is interesting, but sometimes an increasing or growing birth rate beyond a certain point proves to be detrimental in other ways, which we'll get to a lot with development economics. But anything that increases the quantity of factors of production will shift long-run aggregate supply to the right. Anything that increases quality of factors of production. In this case, think about quality of natural resources as better ways to extract, fracking for oil in the United States, better fertilizers, better protection against insects for agricultural goods, genetically modified foods. All those are increases in the productivity of land or productivity of a resource. The increases in quality of labor. Education's a big one. Training and retraining. I don't know why I listed them separately. And apprenticeships programs. Anything that retrains labor for new jobs is a really big deal. Capital investments. Anything that increases the quality of capital. So not just more capital, but now improving the research and development capabilities of a particular country or a company increases the overall quality of goods and availability of those in your country. So if we have increases in any of these factors, the long-run aggregate supply shifts to the right. Decreases in these factors would also shift the curves to the left, but it truly is kind of difficult to think about great examples where you see decreases in these things. It could happen. I pointed the Allied bombing of Germany a couple times in our review with my year 2 students, but the Allied bombing of Germany during World War II or the Allied bombing of Japan during World War II would significantly affect the factors of production for those countries and would shift the long-run aggregate supply curve to the left. So would mass famine or disease. But most often we talk about these things as they are in shifting to the right. So let me go back to, I thought I had it on the last slide, I'm sorry. Let me go back to this model. If we have an increase in labor, there's more people in our country for whatever reason, that's going to increase the new long-run aggregate supply and thereby the new production level. All right, so it would shift the entire long-run aggregate supply curve to the right. If that happens, our GDP, remember that this here is really GDP. So GDP goes from an equilibrium level here to a higher level here. Remembering from previously, increasing labor would be also immigration. Increasing immigrants to your country can boost your GDP. Now, you have to think about like what type of people are coming into your country. Certainly, increasing people who are unproductive or who aren't skilled workers might have a detrimental effect. But many countries have found that increasing labor through immigration helps their country. Countries that are facing declining populations like Japan and Germany are increasing their labor through immigration now as a matter of survival almost, because it increases their overall output. So I know that this is a very quick look at introduction to aggregate demand and aggregate supply. I know you put a lot in your notebooks. We're going to practice a little bit over the next activity. I appreciate your patience going through that. And please, again, if this doesn't make a whole lot of sense, follow up in Cognity so you can take a look at those components together. Thanks, guys.